All right. Hello, and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. And with me today, I'm excited to have the founder of the Not Boring Substack, Packy McCormick. Packy, how are you doing?
Andrew, great to be here. I'm doing well. How are you?
I'm doing great, man. Well, look, let me start the way I do every podcast, and that's by pitching you. First, I had to have you on because YouTube viewers can see you sent me this awesome shirt. But no, look, you're the founder of the Not Boring Substack, and I'm going to let you dive into that in a second. But as I was telling you before we started, I think it's the most interesting of the, there you go, YouTubers.
What a match. Yeah.
A little marketing there too. As I was saying before we started, I think it's the most interesting of the Substacks that we're doing. You're doing so many unique things that I don't think anyone else on Substack is really doing. You know, most people look at Substack and they say the end goal is I monetize my Substack, right? I get 1,000 subscribers, I turn 100 of them into paying subscribers, and that's how I make it. And I think what you're doing is you're building an ecosystem. I'll let you talk a lot more about that, but
Sure.
your post today was gamifying business. You're gamifying the Substack a little bit, I would say, and you're creating this really interesting niche. And also your writing is incredibly interesting. And you can go from one day talking about a 5-person startup to the next day diving deep into the background of tech giants like Tencent or SoftBank. So really been enjoying it. Really appreciate you sending me this shirt. And that pitch out the way, I'll turn it over to you. What is Not Boring and how did you come to start it? What's your background?
Totally. Well, yeah, first of all, thank you. You got the shirt because you've been referring a lot of people and you're one of the top referrers. So really, really appreciate that and the kind words. But yeah, so my story, I kind of have a little bit of the finance and the startup background, which is why I'm able to kind of write about both. But I out of school, came to New York. My internship was in 2008 at Bank of America on an energy trading desk. So I got to see the world, rocket up and then fall apart. It was over 4th of July weekend. I remember leaving and everything was amazing. Coming back, everything was terrible, but it was a bunch of ex-Enron traders. It was a crazy experience. BofA and Merrill merged. So I went to Bank of America Merrill, did that for a few years, was getting ready to go to business school, and had my application in, had my deposit down, ready to go. And I found this company called Breather, which is a real estate startup. It does kind of on-demand meeting and workspace. So decided to pull out of business school just to apply, and ended up kind of after a 4-month application process, getting hired there, ran a New York market, ended up running our kind of all of our physical product and real estate and design and operations and strategy and a bunch of other stuff. Did that for 6 years, which was crazy. Decided to leave at the end of 2019. Was in the middle of starting something kind of place-based. Coronavirus hit. We canceled some of our early events, and then just kind of dove into the writing, which I'd been doing on the side for about a year, and really I was sending out links and listens and just different things that I was interested in. Kind of grew it from very slowly from 0 to about 800 subscribers. And then I decided to give myself a couple months and see if anything could happen with Not Boring. So now what I do is a combination of, as you mentioned, writing about really, really big companies. So that's the Tencents and the Amazons and the Stripes and all of that. And then really, really small companies. So writing about different startups that I find interesting or different industries that I find interesting. And with the really, really small companies, we're able to kind of invest as a group through the Not Boring syndicate. So write about a company, put out an investment memo in public, and if people kind of like the idea and like my take on it, then they can participate in the investing. So really trying to build a little bit more than just a newsletter. I come from, a really kind of complex business previously. And so just sitting down and writing every week and having that be it, I think would get, and not to use it, this is an accident, but happens, would end up being a little bit boring. So really trying to just experiment with it. I think the space is still it feels like everybody has a Substack and it's still also very, very early. So I think there's a lot of room for experimentation on what this can become.
Yeah. So a big piece of Not Boring has been, as you said, you'll write up small companies. A lot of times you'll invest in them, and there's the Not Boring Syndicate, which I guess I'll just throw out. Nothing's investment advice. Everybody can go check out the Not Boring Syndicate, but nothing on here is investment advice. But the Not Boring Syndicate is a big piece, I think, of ultimately how you'll monetize, and I think it's a big value add for a lot of the companies you'll publish on here. What's your background with venture capital? Is this kind of your first series? I guess it's more angel than VC, but is this your first time, or had you been doing that during your time at Breather?
No, I had not been doing it. So we were on the receiving end. I think Breather raised over $120 million. So we were on the receiving end of venture, saw the good parts of venture, the bad parts of venture. But it's certainly my first time kind of leading a syndicate or angel investing. I was doing it personally. And so kind of the genesis of it, I was doing this personally, was writing a check into a friend's company. He had left Airbnb where he ran a piece of Airbnb and was doing something else, and said, I'm having a really hard time kind of explaining why this is a software company and not a real estate company to investors. Would you be able to write something up? Like, I think it'd be so cool to see this in Not Boring. And so we did it. We worked with a friend who had a syndicate, sent him all of the investment interest, and the round was oversubscribed. So I was like, you know what, maybe we should do this. And so we've done now 3 investments, one in a company called Composer, one in a company, actually it's my sister's company. It was a risk, but it's the most oversubscribed that we've had yet, called Oze, and then one called SwayPay. And so far it's been really interesting. One, I think it's a really fun way for the Not Boring community to kind of get together behind a company. 2, really cool way to tell a startup's story. I think a lot of what I write about is business strategy as it relates to tech. And I think even at the very earliest stages, you kind of need to have that in place. And so I look for companies who are kind of open to me sharing their story and their strategy publicly early, because they have something defensible enough that their secret sauce won't kill them if I tell the people kind of what they're up to. And it's been really cool to see, like SwayPay, which is the last one that we wrote about, got 100 different merchants. So what SwayPay does is they'll plug into a Shopify storefront. They'll offer a discount based on your kind of how many Instagram followers you have.
Yep.
And so like the big thing they're doing before lunch right now is recruiting merchants. I think they had 60 people signed up, wrote it, 100 people signed up. They've closed, I think, 100% of those companies, which is insane. But it's cool because the money is kind of one piece, but money is a commodity at this point. But I think what companies get out of it is a chance to tell their story to the people who might be customers or investors or whatever else.
Yeah, no, and look, I think a big thing with venture capital in particular, venture capital and private equity firms both have this, but especially venture capitalists, if you're only providing money, like you're kind of the worst of the venture capitalists, right? Like you're not really going to get access to the great deals. Like you're obviously providing a service here, right? You're providing exposure, the money, but it's just a really interesting model. So I think that's pretty cool. And then what about, so you write up, and we'll dive into one of these in seconds. So you write up big companies and small companies. So how does the big company write-ups fit into the Not Boring Substack?
Yeah. So I think, like the number one advice that you get when you start writing is to find your personal monopoly or like your niche that you're going to be really good at writing about. And I try to avoid business strategy for about a year because so many people do it so well. Ben Thompson's like the canonical example, but Ben Thompson writes about business strategy better than I ever will. And so I really tried to avoid it for a year, but then I started writing about kind of the intersection of maybe pop culture or explaining businesses in a more approachable way by using a little bit of pop culture. And so have just started to dive into companies. So I've done everything from Zoom recently, Opendoor, which I know we'll talk about, Tencent, SoftBank, like all these big companies. And I think the really interesting thing is digging into the backstory, where I think like a lot of newsletters focus on kind of what's happening right now or what product release there was, or did they just raise money, or how are they doing in the market? But I think connecting from the very earliest days to where the company is now and where they're headed and how you can kind of pick up the different clues from what they've done in the past is really interesting. I think I'm increasingly, having started writing, I've always been a techno-optimist, and I think I'm even more of a tech optimist now. I think there's so much potential kind of locked up in these companies, and the leaders in tech right now are going to just get bigger. So it's fun to dive into their story and predict where they might go.
Yeah, as someone who my background is value investing, and the more you talk and think about these tech companies, the more like you published the gamifying of business, I think it is what it was this morning. And the more you talk and think about that, you're like, everything that we're talking about with the future, like the people who are set up for it are the Googles, the Netflix, especially the Tencents, and you look at it, one company I've been looking at a lot recently is like Nordstrom's, and like the thesis there is pretty simple, right? Like every retailer in the world's closed. They're going to come out to the other side. They've got a great brand. But then you think about it and you're like, well, Amazon's a retailer. There's all these Shopify stuff. Like, what is the future for Nordstrom with all these Class A mall stores and stuff? And it's hard to bet on anything. It just seems so easy to bet on all these like FANG companies and stuff. And the more you study them, the more optimistic you kind of get.
I view these as value investments because I think people discount future growth too much in these tech companies just because it feels ridiculous. Like kind of my earlier trading experience coming out of school was being an idiot and investing in Apple options. I should have just bought the stock. But there was just a law of large numbers happening with Apple for a very long time, where it was just hitting its market cap was so high that people were like, and discounted the multiples because it was just too, not expensive. Expensive is the wrong word, but the market cap was too high. And so people discounted it. And I think even though like it kind of broke that 4-minute mile when it broke $1 trillion and everybody else has kind of followed, I still think there's a lot of value because people just feel silly kind of projecting into the future. So like today when I write about business as a game and like, could you run a business through a video game? Like I'm not a video game expert. I don't understand like the technical piece as deeply as I need to. And I've gotten a few replies being like, this is a really interesting idea, but here's what you're missing. The point of those is to really say like, cool, expand your mind. Like something like this will happen in the future. What does the world look like when that's the case? And I think there's more growth than people even anticipate or can imagine at this point.
Yeah, no, I love the idea of Apple breaking the 4-minute mile of the $1 trillion market cap. And then within a couple of years, just everyone's breaking through that. Totally. Yeah, like, look, you look at something like, we've never seen businesses like these before, right? Like I think of something like Google and, there's nothing with the network effects like Google search engine. Somebody put a tweet over the weekend, like, hey, if you gave someone $1 trillion, you could recreate America's railroads, right? But you could give them $1 trillion and like Microsoft basically tried. You couldn't recreate Google search engines. And like the data that they're going to have with autonomous driving and people's YouTube habits and stuff, like it just, you can't recreate that. And when you start thinking about that, you get so bullish onto the future of these things.
Yeah. Hamilton Helmer, who wrote 7 Powers, which is one of my favorite strategy books, was on a podcast and he was talking about Google's network effects and whether Google has network effects. And he's like, the way that you have to think about it is there are all these new, and I'm not going to remember the number, but just an ungodly amount of searches that have never been searched for before. And because they go to Google first, all of a sudden, every time that search happens again and again and again, you're just going to get better results on Google for all of the edge cases than you would on Bing. So Bing and Google, if you search like Apple phone, they'll probably give you the same result. They'll both go to apple.com. But for all of the edge cases, and there are way more edge cases than you'd expect, Google just keeps getting further and further and further ahead.
And then I guess the last thing I want to talk about with Not Boring is, I don't think you've done it as much recently, but for a while, you were running the Not Boring public portfolio, right? And I think if I remember correctly, you had Slack in there, and you even published a post that was like, I'm an idiot for choosing Slack over Zoom, which I guess we were all idiots for that. You had a couple other ones in there. Spotify at the beginning of March, I know, was one which I've to my chagrin, I've always been hugely bullish on Spotify. Like they literally had Netflix's old CFO as their CFO. And for years, he was saying, this is Netflix 2.0, guys. Like, why aren't you guys getting this? I've been a huge bull on that for a while, and to my chagrin, didn't pull it. But what's the future for the Not Boring public portfolio? Is that going to take a back seat, or are you still kind of operating that?
Totally, yeah. I mean, I'm still investing. Typically, I invest in the companies that I write about. My problem as an investor, it works in a bull market. It doesn't work as well in a bear market, is that I'm such an optimist that like, once I dig into a company's story, I'll see the bull case way more easily than I'll see the bear case. And maybe that's right in this new world, and maybe it's not. But when I start diving into a company, I'm like, oh my God, this is a no-brainer. This is going to be the most valuable company in the world. And so I'll invest. But yeah, Slack has dragged me down. The rest of them have performed pretty well. I'm still super bullish. I'd love your thoughts, but I'm still super bullish on Slack long-term. When I wrote about that Zoom versus Slack a while back early in quarantine, I said that it was a long-term thing, but still kind of mentally it hurts when Zoom keeps zooming and Slack doesn't. But I'm still pretty bullish.
No, on Slack particularly, I'm no expert, but I do think Slack's a little bit like, your worry with any tech company is that a larger tech company or a tech company like kind of their size evolves into their market. And like Slack, it does seem like Microsoft's coming to there, Zoom's coming to there a little bit more indirectly. And like, you do worry about the case. Like your biggest bear case for Google is really like search moves to Amazon, right? And your biggest bear case for Amazon is really like, everybody wants to go to these like online Instagram stores, and Shopify kind of out Amazon's, though it's tough to think of a real bear case for Amazon, but yeah, it is. You do work. But, related to what you said, like, does my style of investing work better in a bull market than a bear market? I do think a lot of people have been turned into like kind of investment geniuses over the past 6 months, but totally. I do think being an optimist, when you're talking about these tech companies that scale, like being an optimist, because skew, you strike out, it's still a 0, but you hit a home run, it can be like a 15 times grand slam in tech. I think it's better suited for optimists, to be honest with you.
I completely agree. We'll see if Slack's if that's right on Slack. I actually I really did not subscribe to the Microsoft Teams argument for a very long time because they did all the auto starts and they were inflating their numbers, and it's Microsoft. And so they can kind of push distribution and make their growth curve kind of look any way that they want. I actually think though that pandemic has hurt Slack because it's forced all of these companies who Slack would have had a chance to sell into to just go to whatever they had on their computer right away.
Yeah.
And they have Teams on their computer and it auto starts every time that they open. So if they have to go to a remote chat tool, they're going to go to Teams. I still think long-term Slack strategy of connecting companies through a chat interface makes sense. And there's a lot of, there's a lot of positives there, but it's certainly been disappointing from a growth perspective when everything else is doing as well as it is.
No, it's funny you said I didn't think Microsoft would hurt Slack this much, because you know who else didn't think that? Slack famously took out the New York Times full page advertisement that said, "Come on in, Microsoft, the water's warm, we're ready to compete." And with hindsight, they even did the interview with Stratechery where they're like, "Yep, maybe that wasn't, maybe we weren't ready for that."
Hey, you know what? I'm still bullish long term, and there's just one thing that kind of as I've been writing has come up more and more and more is that if you get the young companies and the young users early, and then you are really, really patient and you kind of grow with them over time, there's an advantage there. I just think that there's probably a tougher selling for them to sell into the corporates as quickly as they wanted to.
Yeah, no, and we'll talk about Opendoor in one second, but it is one thing, you look at a Snapchat, which skews so heavily to I'll just call it the teenager market, versus the core Facebook product today skews so heavily to older audiences.
Yeah.
And when you start projecting that out, it does get really interesting, because if you keep the teens, that's that huge growth part as, today's 13-year-old becomes tomorrow's 14-year-old, and they recruit today's 12-year-old when they turn 13. So it is interesting to think about that.
I'm super bullish Snap too. So we'll see what goes on there.
Hey, that's been a fantastic as well. I remember when they came public, people were saying their CEO, Evan Spiegel. Yeah. Yep. They're like, look, he's the best product guy since Steve Jobs. People were saying that. And obviously they had some rough times, but they had, with Facebook and Instagram, I think they had kind of the worst market position you could imagine, with the best giants trying to attack them. And obviously they've carved out and they've managed to do a lot of interesting things. So that's been really cool.
Yeah. And I mean, just what the breadth of what they're building, I think is super underappreciated with a Snap. Something as simple as Bitmoji being on pretty much, possibly on any keyboard in the world. Samsung's auto putting it on any of preloading it on their keyboards. They have all these different things by opening up everything they build through their SDK, and all these different things where I think Snap is going to be powering a lot more apps. And so whether it's the Snap app itself is the thing, or whether it's Snap's technology being in so many apps that are kind of geared towards that younger market, I think the future is brighter than people expect for Snap.
And I think they're really interested in studying how, for something consumer, just the small things can make the big difference. I think how viral those things are for, they've got this thing where it's a filter, you hold a button down, it flips up what Harry Potter school are you? And it flips through a bunch and it'll tell you, you're Gryffindor or Slytherin. And there's no rhyme or reason to it. It's completely random, but these things go so viral and they drive so much engagement, and anyone could build that, right? But they're the ones who built it, and I think it really speaks well to them. Anyway.
And Reels has, and Instagram stories have, and it spreads a little bit in stories. Obviously, has done very, very, very well. But I think it's really about building the product that your audience wants, in particular too. Teens and kind of Gen Z and young millennials are just so much more likely to share goofy pictures of themselves than me. So, and I'm more likely than most 33-year-olds to share goofy pictures of myself. So I think it's really about
behind you. Yeah,
exactly. So I think it's really about nailing the product for your particular audience. And I think they do that really, really well.
Cool. Well, hey, let's turn to Opendoor. That's kind of the last company you wrote up. I think this is one that's really in the news. It's really easy to imagine this 10 years from now being 15 times the size. As Chamath says, this is his next 10X. You can imagine that. I know a lot of people say you look at the iBuying market and this is going to be a zero over the long term. You could picture that too. So why don't you talk to them? They're going public through a SPAC. What is Opendoor? What's the bull thesis on them? Everything like that.
Yeah. So Opendoor is the original iBuyer. And what that means is that they use technology to price, bid on, and acquire homes. And then they have their network of inspectors and contractors and all these people who understand the fixes they need to make on a house as quickly as humanly possible. They have these like huge kind of economies of scale in terms of the fact that they do so many houses that their costs are now kind of like 50% down across all these different categories of like carpet and wood and all these different things that they do. But essentially they use technology to buy houses and flip those houses, hopefully for a higher price. But they charge both a kind of 0 to 6% to cover costs, and then somewhere between 0 to 6% to as like a liquidity premium. So if you don't have any rush, you probably shouldn't sell to Opendoor. If you just want to sell your house, then maybe you pay a 2% discount and you sell to Opendoor. Opendoor takes that 2%, and then whatever appreciation, hopefully they get on the home, and that's their margin, kind of net of all the costs that they need to do to get the house back in shape. The bull case on Opendoor is that real estate generally, and I come from kind of a commercial real estate startup, is super, super slow to move and is one of the last kind of industries that's really been untransformed by tech. I know that we're both kind of Zillow bulls, and I'm a huge fan there, but really that changes the way that you get in touch with an agent, and Zillow now has an iBuying program as well. I think Zillow is an absolutely incredible company. I think Rich Barton is one of my favorite CEOs. But I think what Opendoor has done really well by focusing on iBuying is just getting this head start in all their markets that kind of just compound over time. So they're the best pricers. I kind of mistakenly thought for a while that this estimate was going to be an excellent input into a pricing model. And it's really, really good as like a broad thing, and incredibly good as a lead generation tool. Not so good on the specifics of like, if this basement is like this, what are the chances that I'm going to have to pay $2,000 to repair the foundation in the basement, for example? And Opendoor over the past 6 years has built up, by having their own inspectors and selling the houses themselves, all this proprietary data that they feed back into the model. So it's not just how's the neighborhood performing, it's how's the neighborhood performing. Are there a bunch of telephone wires across the street, and what does that do for the price? Our inspector said that. Our inspector also said that homes that have, we've seen through all this inspection data that homes that have black spots in the kitchen end up getting mold, and so they cost X, Y, and Z. And so they just have this data set that I think really helps them on the pricing side of things. But I think the bull case for any of these companies is that residential real estate will not stay untransformed. And so I've heard many people say Opendoor, Redfin, and Zillow, just buy all three, and one of them is going to win. And this is going to be $1 trillion market because housing is so huge, and $1.6 trillion in housing changes hands every year in the United States alone. So if you just kind of bet on this trend and don't even pick a horse, you're in pretty good shape.
Yeah, no, I think that's a great overview, but let me back up for a second. So Opendoor, right? My worry here is I've got $1 million house. I'm going to put it up for the market. Opendoor is going to come in.
They won't bid your house, but so they have this tight buy box between 200 and 500,000 for, I think, the reason that you're going to say the 2% starts getting really big. And as you kind of move up into the more luxury market, there's a lot more factors than just like, it becomes less of a commodity when you get more and more expensive. And so they stay in this kind of small box between 2 and 500,000.
Yeah. So I actually chose $1 million just to make the math easy, but let's do 500,000 just to stay. So I've got a $500,000 house, right? Like what Opendoor is going to bid on it. If I'm selling, I'm going to sell to the high bidder in general, right? Why am I going to choose Opendoor? And if I choose them, why haven't they just paid the highest price for my house, which by definition, this is why basically what Opendoor wants to do is buy your house, spruce it up a little bit, flip it in 90 days, right? By definition, they're the high bidder of the house. Why shouldn't they get like kind of pretty poor returns from being the high bidder on an asset?
Yeah, I think they realize which houses they can high bid and which houses they can low bid. Like they have their kind of price elasticity of demand curve in there where, at 10%, maybe 20%, a 10% premium, maybe 20% of the houses convert. At a 2% premium, maybe 60% of the houses convert. And so they're always kind of sliding between there. And it seems like they're really trying to optimize kind of house by house margins versus growth. And so in some cases, they'll throw a high liquidity premium bid on your house and not expect to win it. Their bet is that they're going to be sharper on it so that if Zillow or Redfin or somebody wants to come in on every one of the houses that they're bidding and underbid them, one, their costs are going to be lower. Two, they think their pricing is going to be a little bit more precise and accurate. So sure, Zillow can actually just bleed them dry. If Zillow wants to offer secondary and the market keeps wanting to kind of fund Zillow and iBuying because they see it as $1 trillion opportunity, that I think is a really big risk, is that somebody could bleed them. But I think it requires, without the precision and without the economies of scale that they have, which of course Zillow can acquire over time, without those two things, it's going to require somebody committing to losing a lot of money for a long time. And I think Zillow's done a good job, obviously, at this point of moving their investors over. The stock tanked when they announced iBuying, and then it's been this kind of slow and then rapid decline as they've kind of found an investor base that's comfortable with them doing both lead gen and iBuying, which are two very different businesses. But who knows how patient that investor base is with them bleeding money to try to win iBuying over time.
Yeah, because my worry, and Zillow certainly fits into this, but my worry is like all real estate is local, right? And obviously what Opendoor and Zillow are trying to do is get enough data that they can automatize a lot of the local. But like, I've got 15 friends back, I'm from Louisiana, New Orleans, who, their side job is kind of, or the HGV flip or flop show, right? Like my friends on the side, they'll go buy houses, spend 90 days sprucing them up, and then try to resell them. And like when Zillow or Opendoor bids on a house, like they're obviously competing with these guys, and some of it they can get through with their local knowledge and some of it they can get through with automation, but they are competing against like my friend Jeff, who he lives there. He can actually spend his afternoon, go walk around the thing. Like he's got a lot of knowledge, and I do worry. That's been the worry for a lot of these things, right? Like you're competing against these across the board, and you're never just going to get great returns on capital because of that.
Yeah, I think that's right. And obviously there's not as much centralization as an Amazon, but like that's an argument against an Amazon as well. At some point is like the stores that can physically be there are going to sell to the customers who are in the neighborhood and they have a relationship and they're used to going to the store. And I think certainly obviously until COVID, small retail was doing broadly fine and didn't just go away because of Amazon. And I think similarly, there will be projects that make sense for local folks and projects that make sense for an Opendoor. But what Opendoor has, they're not fully nationwide, right? They're in 20 markets. They have 4% of the Phoenix market. So they do have kind of a reputation in somewhere like a Phoenix. They do have a network of inspectors and contractors, and they do have, through good times and bad, although they stopped buying for a little while, though they're picking back up now, through good times and bad, they can say like, look, contractor X, if you stick with us and you price our bid the lowest, you're going to have 10,000 deals to do over the next couple of years. So they have that advantage. And I think, when you're dealing with contractors, like either if your friends have their own guys, I think that might help. And obviously like that removes a layer of margin from the whole process. But otherwise, contractors are going to go with who pays them the most money over kind of the medium term. I don't think super, super long term, but also not on a job by job basis. If they see that for the next 2 years, I'm going to be able to get 100 jobs by working with Opendoor, that's a big advantage that I think that they have in the local markets.
Yep. And there's probably like scheduling things where if they can schedule Opendoor to be like, hey, we've got 100 houses, come to this job Monday, this job Tuesday, like they don't have to go out selling to get 15 different local jobs.
Right. I've seen a million companies that have tried to do, and like Thumbtack kind of does this, but on the commercial side, try to do like a Thumbtack for contractors or something. And it's really, really hard to do if you don't control the supply. Like they'll just get a better job and they'll ditch whatever job they'd signed up for before. It's a really tough industry to wrangle. And so I think you do need that kind of like massive scale and commitment of jobs to be able to wrangle it. So I don't think there's going to necessarily be like a Thumbtack for full scale contractors on houses. I think it will be iBuyers coming in and just promising kind of big blocks of jobs to these guys.
I think when you first started mentioning Opendoor, you mentioned that, hey, what they're going to do is, I think what you said was, if you need certainty of close and speed, you might be more likely to go with an iBuyer than a kind of traditional, hey, let me put this up and sell it to the highest other families can move in. Why would certainty and speed of closing a house be so important?
And this is an extreme example, but my wife and I are in the middle of selling. We bought like a property that we put on Airbnb upstate. And we luckily, like my friend was looking for a house upstate. His realtor told him that everything was 30% higher than it had been a couple of weeks ago. And so we were like, oh shit, we should probably sell at this point. And so we put it out there. We found a buyer in the middle of that process. And then I think prices actually kind of cooled off a little bit. And so like we've signed the docs, but until that money's in the account, I'm a little bit worried every day. That's one aspect of it. Like there's just this uneasy feeling when the biggest financial transaction that you'll make over a certain amount of time is up in the air. That's one aspect. Another aspect is that people are looking, maybe people already have an offer in on another home. And so to be able to move, they need that certainty so that they know that they have the cash coming in, even if it's a little bit less. Because for a lot of these people, potentially the house is appreciated maybe 20, 30%. And so the difference between, selling for a 30% markup from where you bought and then 28 is not that much relative to just, I'm going to get the cash in my account in like 3 days. And so I think there's value to that as well.
Yeah. Get the cash in my account and be able to close on the next house that I actually have a time crunch on.
And I mean, your return is going to just far out. If you start investing in SPACs with the money that you get for that 3-month period, right? Like your returns are going to far outweigh that 2% delta.
That's a, no. And one of the things that and I'm going to use this as a transition to Zillow, but one of the things that like stands out from your write-up is I originally thought, one of my things when I look at companies, I love the company that controls the top of the funnel, right? And
me too.
When I thought Zillow, I thought, as you point out, Zillow's estimate, that is the top of the funnel. And that has been Zillow's thing to lure in people to hire real estate agents with them. And that I was kind of thinking, oh, that's the thing that's going to encourage them to buy through Zillow, right? They go for the Zestimate, they stay, and they just sell their house for the Zestimate. And what you pointed out, and I thought this was such a good point, was, hey, your house is by far the largest thing for 99% of Americans. It's the largest transaction they'll ever make. You're not going to take the first bid just because you went and got the Zillow's estimate, right? Like you'll get the Zillow bid and then you'll probably go and check Opendoor. And if Opendoor is better at pricing, it doesn't matter. They don't control the top of the funnel. As long as you can find them through a Google search, they're going to be able to get their best bid in and they can beat Zillow through that if they've got better data and all of that type of stuff.
Yeah. Because pricing isn't about having the lowest price. Pricing is about knowing better than anyone else the highest price that you can pay and still make the margin that you want. And so, yeah, they're going to, if they can figure out a way to squeeze more into that price and they're the second or the third place that somebody looks, they're going to win that deal. And it's the point that you made before. Like people are going to shop around, look for the highest price, and they'll sell to whoever has the highest price. That's my bull case on Zillow as well. And I bet they do pick up a ton of people who don't price shop. I mean, I think the other thing that we haven't discussed is just that I think this market more than most others can support a bunch of winners. Your friends can do really, really well locally. Opendoor and Zillow can do really, really well. But I think for the majority of people, it's actually a benefit to Opendoor to have someone like Zillow out there educating people on the fact that you could sell your home at the price at the click of a button. And if Zillow has brand trust with people and they do it, then I think it lends an air of legitimacy to iBuying that then when Opendoor has a better bid, they can take advantage of without having had to build that top of funnel.
Yep. One of the things that I've thought is interesting here is like, a lot of Zillow's traditional margin has come between matching people with, especially real estate agents, but increasingly they were, hey, we'll match you with the mortgage broker and we'll get a fee for matching you with the mortgage, insurance, all that.
And they bought a mortgage provider as well.
Say again?
And they bought a mortgage provider as well, yeah.
And Opendoor actually has I believe they bought a title insurance company, right? And one of the things I wonder is, we talked about top of the funnel with Zestimate. One thing I wonder with Opendoor is longer term, does it maybe make sense? Like, hey, we run the actual buying and selling of the houses at like basically zero margin. And then we make all of our money on, we're going to do the title insurance. We're going to get you a mortgage for your next home. We're going to set you up with the real estate agent to buy your next home, or we keep all the real estate agent commission for us because we buy a home from one person, we buy a home from you and we sell you a home that we already own. Like, I wonder if the flipping is a 0% margin and they make all their margin on everything else connected because there's so much.
They're so scientific, right? Like this is just their DNA is how do you drive the cost down as low as you possibly can, that I'm sure right now, like their attach rate on title is like 82%. So 82% of the people that they offer title to, or maybe even higher, go with title. Title is this like regulated industry where the margin's locked in at like 75%. If you can get somebody to do title with you, like that's just free money essentially. And so I think at some point, and that's just one thing, I think at some point they're going to start, buying and selling these houses at a loss to be able to get these other things. I think Amazon buys them at some point. It's like I kind of just slid in at the end of the essay, because like if you're trying to win the home, I think just kind of like being that first point of contact with the buying and selling process, you can just attach so many other things on there. And so right now it's low LTV, high margin things like title insurance. Over time, I think they'll probably work to increase the LTV so they can treat the loss in the home as just a CAC, and the CAC LTV starts looking really good.
So you think like Amazon buys them because Opendoor buys your house, I buys your house, and then Amazon will install like Echo in every room, and then they sell you the Amazon pre-equipped house.
And then you have Amazon Prime, and you're just going to be shopping with Amazon thereafter. I mean, they spend like billions of dollars on content, for example, to get people to use Prime. Why not spend 10 billion to buy Opendoor to be that first point?
That's interesting. So I've looked at the master plan communities before, which, they own a giant block of land, and then they build the grocery center, and then they build 1,000 houses around it, and they kill it. And I have wondered before, like, why doesn't Amazon do that and build the entire community based around like a Whole Foods and a super efficient Amazon distribution center, right? And then you build Amazon into everything, and anyone who moves in there, you can almost sell the houses at zero margin, because everyone who moves in there becomes the best customers that Amazon will ever have. And it sounds like you think Opendoor could do something similar.
I think they could do it themselves and limit the number of things that you sell to people and limit the LTV, or you can go into an Amazon. The Opendoor piece is profitable on all the things that they attach to the first purchase. And then like home cleaning and like all these things that they can like really kind of control at scale in a local market. And I know that's an oxymoron. So they can do all of that on kind of the first sale, start adding some repeating things that relate to kind of managing the house itself. But with Amazon, your LTV is like pretty much unlimited at that point. If you make sure that people think of Amazon for everything that they're going to buy, home related or otherwise.
So let's talk management here, right? I think this is interesting because you're attacking a $1 trillion to $2 trillion industry, right? Like the companies that, if you can win iBuying, you can be maybe the biggest company in America, right?
Yep.
So when you talk Opendoor and Zillow, I think it's interesting because you've got two really storied management teams there. I guess Opendoor is more, you've got a storied financial backer than actually management team there. But how do you think about that? Like, what's the background for these management teams and backers, and do you favor one over the other?
I think on management, it's probably a tie, and I can't believe that I'm even saying that. Like, Rich Barton has built this business before. I don't know if you've read, there's an incredible piece that Kevin Kwok wrote on Rich Barton's loops, and the fact that
for the listeners, Rich Barton is the current CEO of Zillow and the founder, but go ahead.
Currency of Zillow, was it Expedia also? And so what he does is just build these businesses that have content, and in Zillow's case, that's the Zestimate, where essentially he just ranks first in search engine. Whenever you search for, pick an address in your city right now, and Zillow is going to come up first. And so versus, anybody else in the industry, you're just paying less to acquire customers because you're first in the search results. And it's a thing that he's done, I think, 3 times now. And so Zillow's the 3rd time. Rich Barton, his interview with Ben Thompson is another one of like just the best things that I've ever read in my life, and made me fall in love with Rich Barton as a CEO. I think on the Opendoor side, they were founded by Keith Raboy, who's a venture capitalist who also worked at PayPal and Square, and also has a pretty incredible track record himself. And then Eric Wu, who has been in real estate, has had some moderate successes. This is his first like massive success. And then they've built up a team of executives from Amazon and all of the different tech companies to come work there. So maybe I give a little bit of an edge on management team or just CEO to Zillow. But I think like the other piece of that is just the culture that they built from day one at Opendoor. And they have my favorite cultural value of all time, which is bips for breakfast, which means that they just like pull basis points out of the business wherever they can at any time. And Eric Wu, and I've watched, 10 interviews with the guy now as part of this process, and just always talks about having to make the hard decisions to lay people off, or they removed free lunches, and like do all these little things culturally that you just expect if you're going to work at Opendoor. And so I think like if the management team is relatively equal, the fact that you have this culture built up, people just understanding that like all we do is minimize costs and make our algorithm better, then I think like there's a kind of team advantage that you build up over time by having everybody buy into that culture.
Yeah, and the bips for breakfast, I think a lot of people say bips, which are basis points, a fraction of a fraction, a fraction of a percent, say, oh, is that a big deal? But homes, it's $1 trillion industry, but these iBuyers, they're talking about operating on sub 5% margins. So like bips are actually really, really big. And one of the things I was sending you separately is, I think Zillow right now is minus 2% margin on their iBuying, whereas Opendoor, I think on the iBuying itself, they're slightly positive margin.
They are, yep.
Yeah, and I was saying like, look, when you look at the differences here, it's not that much. And you have to, if you're bearish on Zillow, which I think the people here were, like you have to explain why Zillow can never narrow those cost differences. And you're not talking like, it's talking, hey, Zillow's expenses are 4% of the sales versus their maintenance costs are 4% versus 3%. It's like, that doesn't sound like a big difference, but it actually makes a huge difference when you're talking margins.
Because it's essentially like, just the way that the accounting works in real estate, like the revenue is the total, value of the home. And really what you're talking about, like the net revenue or the margin is this like little, I think for Zillow, it's -2. For Opendoor, it's 1.9% after interest right now. And so like your net revenue is really that. And so a 1% difference is like 50% of the revenue. It's a massive, massive difference. So anywhere that you can remove costs, one, helps right now with the margin and helps more drop to the bottom line and all that. But two, over time, and this is why I'm not certain that Zillow catches up, is that you can just keep getting better at pricing and you can just keep lowering costs. Like the lower your costs are, the lower bids that you can make and still make a margin. The more volume you get, the more scale you get, the lower your input costs are, the lower your labor costs end up being, because as you said before, you can like kind of block people in different slots. And so it's just this advantage that compounds. I don't think it's the same kind of compounding advantage that maybe a Google has, where it's just the internet and it's this infinite scale, but there are these compounding advantages that they have.
I just think there's a limit in the physical real estate sector to how big of an advantage, how low you can get your costs, right? Because like at some point, like the contractor, yeah, maybe he'll take 100 an hour versus 110 an hour from someone else because you're guaranteed and you're going to fit into his schedule better. But at some point, he's not going to cut even further, he actually has to get paid for his time. And there's a lot of these things, a lot of people talk about, oh, you're going to get lower interest rate costs. Well, that's just cost of capital. Somebody with lower cost of capital can always step in, or somebody who can equal you. And there's just a lot of these things where I do think you kind of reach the natural limit, or, pricing, like at some point, you're not going to be able to cut your pricing that much lower. So I do think there are some limits.
Except for what we talked about earlier, where like the more you can attach, the lower and lower and lower
and
lower and lower.
Exactly.
And you expand the market a little bit as well. I think by making it so easy to buy and sell a home, like one of the things that I wrote about, and they haven't said this publicly, but is really the idea that like home buying can be as easy as renting at some point, like when they handle moving and they buy your furniture for you, and they like, it just becomes a lot more liquid and the transaction volume goes up. And so those advantages then, like, it just gives them another little opportunity to compound. But I do totally agree with your broader point there.
When you wrote that, one of the things I thought was Carvana, which is used car retailing. They said, look, the average person does a used car transaction once every 7 years. And they're like, if you think about what the used car transaction is in someone's heads, it's going to a sleazy used car dealership and really having to negotiate. It's this awful process. They're like, if we make this really easy, like our base case is once every 7 years, but if we make this really easy and really seamless and we cut the cost enough, like why couldn't people do it once every 6 years, once every 5 years? And similarly for home buying, like, obviously it's a big expense, but the US government encourages it a lot, right? Like we defer a lot of taxes. Why couldn't the average person move once every 15 years instead of once every 20 years if they make this whole thing so much easier and they lower a lot of these frictional costs? So yeah, I'm with you there.
I think that happens. And I mean, it'll be really interesting. Like I just love this space generally and love being able to watch this space over time, because it's going to be a war of attrition potentially. It's either a really big market and they decide to not play against each other. Zillow's gone into all the markets that Opendoor started out in, so they are deciding to compete head to head. So it's not that. So it's a bit of a war of attrition here, and we'll see if Zillow can catch up to Opendoor's advantages before they just give up and say, hey, we're actually going to just send leads to Opendoor and make our money that way and go back to this high margin business that we had before. And, we'll own all of the rest of housing and they'll own these tens of thousands of transactions a year, but certainly not the entire market. So
last bear case I'll put to you, and then we'll kind of wrap this up, is you said Zillow's moving to all of Opendoor's markets, right? And I think a lot of people had said, look, Opendoor, their first market is, I think it's Phoenix.
Phoenix,
right?
yep.
And the reason they went is the housing stock in Phoenix is new. The housing stock in Phoenix, because they did a lot of cookie cutter homes, I think it's a lot more homogeneous, a lot more similar across the board than, I'm from New Orleans. So you'll have a house that's 100 years old next to a house that's 10 years old with hugely different floor plates. And the house that is 100 years old needs a lot of upkeep versus in Phoenix, if everything's like 10 to 15 years old, needs a lot less upkeep. So I do think a lot of people look at this and say, hey, there's a reason everyone's going into the same markets, right? They're not, Zillow's not choosing, hey, nobody's in New Orleans, let's go start in New Orleans. They'd rather go attack in Phoenix. Do you think that's an issue, or do you think over time, as they kind of get the core down in Phoenix, it's pretty easy for them eventually to go to the New Orleans market, I keep saying?
Yeah, and I use Athens, where we had the Airbnb house, as my example, because the house is built in 1895 and the foundation has issue. Like, that is a much, much harder market to get into. And so I think, I don't know, the way that they talk about it in their deck, they have kind of this $1.6 trillion of houses change hands number. But then the way that they talk about their opportunity is, if we do what we did in Phoenix in 100 markets, and so there's a lot more than 100 markets in the United States, if we do it in 100 over the next X number of years, it'll be a $50 billion revenue business. And that's the gross revenue, full value of the home, et cetera. But that's what they're looking at. I don't think they're basing their numbers on being able to do this in every market anytime soon. I think over time, the software and the internet will work its way kind of into everything. And certainly they'll probably build lower weight products that, maybe they'll come in and compete with Zillow or whatever else. But I don't think they need to win the New Orleans or the Athens, New York, or anything like that in order to get to pretty massive scale.
Yeah. And I think another bear thesis that a lot of people said was, hey, there's going to be, in the next recession, housing prices are going to go down and all these guys are going to get slaughtered. And maybe the pandemic was a complete unique one-time thing. And it was pretty darn fast, everything. But all these guys, they weren't unscathed, but they did survive the March, April timeframe. So I do think that laid at least part of that worry to bed. I don't know how you feel about that.
Yeah. And this has been such a weird recession or whatever you want to call it, because this is not the test that people are looking for, where housing prices across the country drop 5% or anything like that. Like, housing prices in a lot of markets are up significantly.
Yeah.
And in the markets that they're in, like, they're in a lot of the markets that people are moving out of the cities and into. So there's actually, this has kind of been a positive. I think that they ended up kind of selling down their portfolio as much for the uncertainty on their end of, like, will we be able to go to the place where we need to sign the documents, or where the title is held, or is the city going to actually be operating and like doing deals? And so I think there was kind of uncertainty, less around price and more around just like the ability to do business. So this has been just such a bizarre downturn for them to be tested on. I think to the extent that you get something where prices drop 5% overnight, that's not good. But their argument would be, nothing actually drops 5% overnight. People hold out. And so housing prices kind of drift slowly. Even in the financial crisis, housing prices took a while to kind of hit their trough. And because we only hold for 90 days and we're the best pricers and we provide certainty in an uncertain market, we actually are in a better position than anyone else in a downturn.
And if their margin, like they say they can get 5% margin, like if their margin is actually 5%, then if housing prices only drop by 5%, they should be protected, right? Like, they're not going to be posting crazy losses. They're going to be basically break even. And hopefully, as we talked about, they can make their profit on the title insurance and all the add-ons that eventually they'll be able to do.
Totally.
Anything else we should be talking about with Opendoor?
I think we covered a lot with Opendoor.
I'm surprised by how much you got through. It's a super interesting company. All right, here's the real test. Opendoor, I think we mentioned you're long Zillow, you're long Slack, a couple others. Is Opendoor joining the not boring public portfolio?
Oh, 100%. Opendoor is in there, and I'll kind of continue to buy. It's so tough. Like, all of my buys are long-term, just because of, I think, like, the nature of tech, and also just the nature of how you should be investing generally. But Opendoor has gone from, the 10, every SPAC price is at 10 to, I think it was up to 17 $17 today. So it's already up a bunch, even since I bought it around kind of 14, 15. And I have no idea what it's going to do in the short term, like zero idea in the short term, but long term, I feel pretty good about it. And to your earlier point, it's either zero, and that's the downside, or it's 10 to 15x. And so like, it feels like a risk that's worth taking, particularly because SPACs are bizarre, and we can talk about them at some point, but particularly because like these things kind of have to close. And so they price fairly aggressively before they start trading up and going wild. Like $4.8 billion, if you could have gotten it at $10, is just such an unbelievable entry point, I think, on a business like Opendoor's.
It's interesting because even when I dilute for the warrants, I think at 17, I think it comes out to about a $10 billion market cap is what it comes out to. And like, again, when you talk about this future and like, you know, title insurers, if they could become the fourth largest title insurer in the United States, that alone will be worth their entire market cap today. To ignore every other opportunity they have, right? But, you know, I don't know. It's really interesting because this is the company that SPACs were meant for. And like, the previous IPO SPAC space, I thought that was kind of more of a moonshot rocket. This is the
literally
thing where you look at it and like, I can paint a picture where, hey, this is hugely risky, but when this works, this is going to be worth 20 times the current price or something. You know, he said this is my next 10x, and that makes sense. And he's doing IPO C, IPO D, and IPO E at this point. So
and F, I think he has 6 total funded now, and then he reserved all the other letters in the alphabet.
And I'm just tempted. I don't know what I haven't looked at them, but
I bought C. I bought some C the other day. Because I mean, inevitably on these things, it's like when Warren Buffett buys something at this point, like when Chamath picks a target, it's going to pop a little bit.
I think you're probably right. I mean, gosh, IPOC is at $12.25. That's insane for something with $10 in trust. I think you're right. I think you're right. It's really interesting, and it'll be super interesting to see. But you do worry, like, I've never seen anything as crazy as the SPAC bubble. You know, like Opendoor reached a deal to sell themselves for $4.8 billion. And today at 17, the market's saying, hey, that deal you reached a month ago, it was wrong. You're worth twice that. And there's a lot of other incentives and stuff, but it's just really crazy.
I think and this is like the Bill Gurley thing on IPOs, and like in an irrational market, it's hard to say which of these make sense and which of these don't make sense, or irrational or optimistic, or however you want to call a market like this. Like you could have priced Snowflake at 300 and it would have popped for a little bit initially. Right. And so like, it's not like they're necessarily leaving money on the table because the market went a little bit crazy. I do think that SPACs obviously are wild now. I saw something like, I think it was Postmarket tweeted something like, oh, interesting. There's 300 SPACs. There are not 300 companies that have become SPAC quality. I think things like this are really good to kind of push the edges and figure out what needs to happen in like the more kind of traditional process and traditional market. Because does it make sense that the public market should be investing in riskier early companies uncapped? Maybe, maybe not. And like there's a whole conversation and argument to be had there and about accreditation and all of that stuff. But like, would this open the door for unaccredited investors to be able to join price rounds where someone, you know, who knows what they're doing, who's a professional venture capitalist, whatever, is coming in and pricing around and saying, we have $1 million allocation for retail. And you're not going to be buying at like 95,000x revenue multiples because someone actually has to make a return on that. So I think, you know, the idea of retail investors being able to share in the upside, awesome. The idea of retail investors maybe being wiped out by the downside, scary. And I think SPACs will kind of be this thing that pushes regulators to figure out maybe what the right approach is here. Because it is crazy how much of this value is created and captured in the private market and then to the people who get the allocations in an IPO.
Yeah, no, I think part of that, right? I mean, with the SPACs, you know, like the ones around electric vehicles and stuff right now, like
crazy.
Nikola's crazy is because of the story, but there are a lot of ones that, you know, two months ago were thinking they were going to be bankrupt, and now they're announcing SPAC deals and getting valued at like $10 billion. Like that's crazy. But like, I'm really, even though I don't know if I'm going to do Opendoor or not, like I'm just really happy, like Opendoor, which is completely new, completely unique, like the opportunity for that. And like, I'm excited for that type of company to come public and just have the opportunity.
I want Stripe to go public so bad. I mean, it's going to be bought up unbelievably. And I think Ackman talked to them and they said they weren't ready, or he said they weren't ready, which I'm sure he just rebuffed them. I wonder if Chamath might have enough pull in tech to convince them to do something.
And then with Stripe, like if you're Stripe and Ackman comes to you, right? Why go with Ackman? Like go with some fly-by-night SPAC that's going to give you the greatest economics you could ever dream of, right? Like No, and that's the thing with a lot of these companies, like you just have a bake off because every SPAC is pretty much the same aside from the name brand. And obviously Chamath like brings a little bit of an extra following stuff, but have a bake off. And I bet you could get a SPAC that's going to say like, we'll value at, you think you're worth 20, we'll value at 120 or something.
Totally. You know who I'm super bullish on, and his one of the analysts there just started tweeting about Stripe and did a thread the other day. But Altimeter is doing a SPAC, and Altimeter is. Are you familiar with them?
I'm familiar with a couple. They all start blending together at some point.
Yeah. So Altimeter is a fund that is both private market and public market.
Yep.
Tech fund, slightly thesis driven, invested in ByteDance early, just like has this incredible portfolio and track record across private and public markets. And they have a SPAC, and one of their analysts started tweeting about Stripe the other day. I doubt it'll happen, but I think like outside of Chamath, that's where it hasn't, I don't think priced, it hasn't gone public yet. But that's one that blindly I would put my money in as well, because they have such a strong track record. So maybe you see an Altimeter come in and convince Stripe.
You know who else has a SPAC? I think it's just about to launch. Rich Barton's launching a SPAC too. So that'll be an interesting one.
That makes me a little tiny bit bearish on Zillow. Like I think Casper CEO had a Slack also. Like I think active CEOs raising SPACs is a little bit crazy. But who knows?
Cool. Well, hey, this has been so much fun. I think we're running about an hour, so I've taken up a lot of your time. You know what? We've got IPOC, IPOD, IPOE. We can just have you on for every IPO SPAC that comes on. But
I love that.
Look, Packy, I love Not Boring. I'll be sure to include a link in the show notes. Everybody who listens should sign up. I think they will be encouraged to after this. Thanks so much for coming on, and we'll stay in touch.
Awesome. Thanks for having me.
Later on.